Gross domestic product, GDP, measures the total market value of all final goods and services produced inside a country's borders in a given period, usually a year. Think of it as the total sales made by every shop, factory, and service provider that operates within the country's fence. Gross national income, GNI, expands the view. It adds income earned by residents from abroad like a multinational's profit from its overseas subsidiary and subtracts income earned by foreigners inside the country. In simple terms, GDP is what is made here while GNI is what is earned by our people wherever they earn it. Classification both can be reported as nominal, current price, or real, inflation adjusted. They can also be broken down by sector: agriculture, industry, services, or by type of spending: consumption, investment, government, net exports. The scope of GDP excludes intermediate goods to avoid double counting, includes only market transactions, and treats government services as if they were paid for at market prices. GNI's scope adds the net factor income from abroad, NFIA, the balance of wages, profits, and rents that residents receive from foreign production. The expenditure approach adds up all spending on final output. The classic formula is GDP equals C plus I plus G plus X minus M. C. Consumption, household purchases of goods and services such as groceries, haircuts, and streaming subscriptions. I. Investment, business spending on equipment, construction of new factories, and residential building. G. Government spending, salaries of teachers, road building, defense, only what the government actually buys, not transfer payments like pensions. X. Exports, and M. Imports. Goods sold abroad add to GDP, goods bought from abroad are subtracted because they were not produced domestically. Numerical example. Suppose in country A during 2025, consumption equals $500 billion, investment equals $150 billion, government spending equals $200 billion, exports equal $80 billion, imports equal $70 billion. GDP equals 500 plus 150 plus 200 plus 80 minus 70 equals $860 billion. This single number tells us the total market value of everything produced inside country A in 2025. The income approach adds up all incomes earned in the production of goods and services. Wages and salaries. W. Compensation of employees. Rent. R. Income from land and property. Interest. I. Earnings on capital, loans, bonds. Profits. P. Corporate surplus after paying wages, rent, and interest. Mathematically, GDP equals W plus R plus I plus P plus indirect taxes minus subsidies. Indirect taxes, sales tax, VAT, are added because they raise the market price of goods. Subsidies are subtracted because they lower the price. In country B for 2023, W equals $400 billion, R equals $50 billion, I equals $30 billion, P equals $200 billion, indirect taxes equals $40 billion, subsidies equals $10 billion. GDP equals 400 plus 50 plus 30 plus 200 plus 40 minus 10 equals $710 billion. The same GDP can be reached from the spending side, confirming national accounts consistency. Explanation: the production value added approach looks at the economy as a chain of producers. Each firm adds value equal to its output sales, minus the cost of intermediate inputs, materials bought from other firms. Adding the value added of every firm gives total GDP. Methodology. 1 point. List all industries: agriculture, mining, manufacturing, services. 2 point. For each industry, compute value added equals gross output minus intermediate consumption. 3 point. Sum across industries. Illustrative example: imagine a simple economy with 3 firms. Farmer grows wheat, sells it for $100 to a bakery. Intermediate consumption equals $0. Value added equals $100. Bakery buys wheat for $100, bakes bread, sells it for $250 to consumers. Intermediate consumption equals $100. Value added equals $250 minus $100 equals $150. Retailer buys bread for $250, sells it for $300 to final buyers. Intermediate consumption equals $250. Value added equals $300 minus $250 equals $50. Total GDP equals $100 plus $150 plus $50 equals $300, which equals the final sales price of the bread to the consumer. This method avoids double counting because each intermediate sale is subtracted once. Nominal GDP is measured using current year prices. It reflects both real production changes and price changes, inflation. Real GDP strips out inflation, showing only the change in quantities produced. The GDP deflator is the price index that converts nominal GDP into real GDP. Formula: real GDP equals nominal GDP divided by GDP deflator times 100. The deflator is calculated as nominal GDP divided by real GDP times 100. Example: suppose country C's nominal GDP in 2024 is $1,200 billion. The GDP deflator for 2024, base year 2020, is 125. Real GDP equals 1,200 divided by 125 times 100 equals $960 billion, 2020 dollars. This tells us that the economy's output grew from $800 billion in 2020 to $960 billion in 2024, a 20% real increase, while the 50% rise in nominal GDP was partly due to a 25% price rise. Net factor income from abroad captures the earnings residents received from abroad minus the earnings foreigners received domestically. To move from gross domestic product to gross national income, add net factor income from abroad. Gross national income equals gross domestic product plus net factor income from abroad. Example: in country D, gross domestic product equals $500 billion. Residents own a foreign mining operation that sends $30 billion of profit back home. At the same time, a foreign company operating in D pays $10 billion in profits to its parent abroad. Net factor income from abroad equals $30 billion minus $10 billion equals $20 billion. Hence, gross national income equals $500 billion plus $20 billion equals $520 billion. Gross national income reflects the total income available to the country's residents, regardless of where the production occurs. GDP per capita equals GDP divided by population. It approximates average economic output per person and is often used to compare living standards across countries. GNI per capita equals GNI divided by population, indicating average income earned by residents. Computation example: country E has GDP equals $1,000 billion, GNI equals $950 billion, population equals 50 million. GDP per capita equals 1 million divided by 50 million equals $20,000. GNI per capita equals 950,000 million divided by 50 million equals $19,000. Interpretation: if GDP per capita grows faster than GNI per capita, the country may be producing more, but a larger share of the earnings is leaving, for example, high foreign ownership. Conversely, a higher GNI per capita suggests that residents are capturing more of the nation's productive capacity, a sign of potentially higher welfare. While GDP and GNI are powerful gauges of economic activity, they have notable limitations as welfare indicators. Non-market activities, home care, volunteer work, and underground economies are omitted, understating true welfare. Distribution matters. GDP per capita is an average. It hides inequality. A country could have high GDP, but most wealth concentrated in a few hands. Environmental degradation. GDP counts the value of extracting natural resources or polluting production, even though these may reduce future welfare. Quality of life, health, education, leisure, and security are not captured. Externalities and sustainability over consumption of resources may boost GDP now, but hurt long-term welfare. Common exam critique: students are often asked to point out that a GDP ignores informal sector, b. It does not account for depreciation of natural capital, c. It measures quantity not quality, and d. GNI can be misleading for small open economies, where large NFI swings cause big gaps between GDP and resident income. Answering with clear examples like a mining-rich country with high GDP, but low GNI because profits flow abroad demonstrates